That first $10,000 you just saved is the most dangerous money you'll ever have. It took months of sacrifice to get it, and according to the Federal Reserve, it's nearly double the median $5,400 savings for people your age. But with inflation at 3.0%, a single psychological mistake, one that new 2024 data from S&P shows fails 65% of the time, could make it all disappear. First, let's break down the psychological trap that 99% of new investors fall into. Reaching that $10,000 milestone is not a small feat. It's a monumental achievement that deserves to be acknowledged. We need to translate that number into what it really represents: your time, your discipline, and your effort. According to the Bureau of Labor Statistics' latest data for Q4 2024, the median weekly salary for someone in your age group is $1,125. That means to save $10,000, you had to work for over 2 solid months, non-stop. And that's before a single dollar was taken out for taxes, rent, or groceries. That's 2 months of your life dedicated to this goal. It's the sum of countless small decisions. Saying no to dinner with friends, skipping the vacation, brewing coffee at home instead of buying it. You operated in what psychologists call scarcity mode, where every dollar was precious and every spending decision was scrutinized. This mode makes you an excellent saver, but the moment you hit your goal, a dangerous switch flips in your brain. You shift from scarcity mode to high-stakes mode. The money is no longer a goal to be reached. It's a treasure to be protected. The fear of losing it becomes overwhelming. And this isn't just a feeling in your head. It's backed by data. The Federal Reserve's 2024 Survey of Consumer Finances revealed that the median savings for someone under 35 is just $5,400. You are holding nearly double that amount. Your $10,000 isn't just money anymore. It's a symbol of being ahead of the curve. It feels like your one big shot to change your life, precisely because it's so much more than what your peers have. This intense pressure is what makes you vulnerable. It creates a psychological weight that can crush good decision-making. You start to feel that playing it safe isn't enough. The money needs to do something spectacular. This high-stakes feeling is the gateway to the most destructive temptation for a new investor: the get-rich-quick idea. Your mind, terrified of losing this precious sum, paradoxically starts looking for a magic bullet to multiply it. You scroll through social media and see stories of people who supposedly turned a few thousand into a fortune overnight on a speculative stock or a new crypto coin. The pressure mounts. You feel like you're falling behind if your $10,000 isn't also performing miracles. This feeling pushes you towards behavior that looks and feels a lot like gambling. You know it's risky, but the fear of missing out, combined with the immense pressure of holding a sum of money that feels life-changing, can cloud your judgment and make you consider options you'd normally recognize as reckless. This is the trap. The very success of saving the money creates the psychological conditions that are most likely to make you lose it. Let's make this real with a story. Meet Alex. Alex is 29, a talented graphic designer earning a salary of $58,500 a year, which is right around that median income we just talked about. For the last 6 months, Alex has been on a mission. Every expense was tracked. Subscriptions were canceled, meals were prepped at home, and freelance gigs were picked up on weekends. By doing this, Alex managed to cut monthly expenses from $4,000 down to a lean $3,200. The extra $800 a month, plus some extra savings, finally added up. After half a year of intense focus, Alex hit the goal. $10,000, sitting in a standard, low-interest savings account. It's the most money Alex has ever had at one time. But the initial feeling of triumph quickly faded and was replaced by a constant low-grade anxiety. Every day, the news talks about inflation, and Alex knows that the $10,000 is slowly losing its value just sitting there. But every investment option feels like a casino. The stock market seems impossibly complex. Friends are talking about a tech stock that's guaranteed to pop. The pressure to do something, to turn this $10,000 into life-changing money, is immense. This pressure leads to paralysis, punctuated by moments of seriously considering dumping it all into that one high-risk stock just for a chance to catch up. The first step for Alex wasn't about picking an investment. It was about changing the entire frame of mind. The goal had to shift from the stressful get-rich-quick to the empowering protect and grow wealth systematically. Alex had to understand that the intense pressure wasn't a personal failing. It was a completely normal psychological response to holding a statistically significant amount of money for the first time. By committing to a data-driven plan instead of an emotional one, Alex found a sense of relief. The clarity cut through the noise of speculative temptations, and for the first time, Alex felt ready to look for a reliable strategy instead of a lottery ticket. This pressure to gamble feels personal, but it's not. In the next section, I'll show you the hard 2024 data from S&P that proves why the boring path is actually the smartest one, and why trying to beat the market is a game rigged against you. So, you've resisted the psychological urge to gamble. Now, we need to replace that emotional pressure with cold, hard data. The single biggest myth that traps new investors is the idea that they can find the next big thing. That with enough research, they can pick the one stock that will outperform everything else. But this is a fantasy. And we have the definitive proof. Every year, S&P Dow Jones Indices releases their SPIVA scorecard. It's the official report card that measures how professional money managers perform against the market average. The results from the year-end 2024 report are crystal clear. 65% of professional large-cap fund managers failed to beat a simple S&P 500 index fund. Let that sink in. These are people whose entire job, backed by teams of analysts and sophisticated software, is to pick winning stocks. And the majority of them, nearly 2 out of 3, could not do better than just buying a slice of the entire market and holding it. If the highly paid experts on Wall Street can't consistently beat the average, what makes us think we can do it from our laptops on a Tuesday night? This single statistic should be liberating. It releases you from the pressure of having to be a genius. Your goal isn't to find the needle in the haystack. It's to buy the entire haystack. Accepting that boring wins is the first step. The next is understanding that doing nothing is not a safe option. It's a guaranteed loss. This risk is called inflation. According to the latest data from the U.S. Bureau of Labor Statistics for November 2024, the annual inflation rate is running at 3.0%. This means that every year the prices of goods and services are, on average, 3% more expensive. If your money isn't growing by at least that much, you are getting poor. Let's quantify it. Your $10,000 sitting in a checking or standard savings account earning close to zero interest is losing $300 of its purchasing power every single year. That's $25 every month that vanishes into thin air. It's the equivalent of taking 3 $100 bills out of your stack of cash and lighting them on fire on January 1st. You still have the same number of dollars, but what you can buy with them shrinks. Doing nothing feels safe because the number in your account doesn't go down. But in the real world, where you actually have to buy things, you are actively losing money every single day. The risk of inaction is silent, but it is certain and relentless. Now let's talk about the other side of the coin, the cost of making a big mistake. A speculative bet that goes wrong isn't just about the money you lose in that moment. The true cost is the opportunity cost, what that money could have become if it had been invested wisely. This is where the numbers get truly staggering. Let's say you get tempted and you put $4,000 of your $10,000 into a speculative meme stock that goes to zero. You lost $4,000, right? Wrong. You lost so much more. The S&P 500, which represents the broad U.S. stock market, has a historical 10-year average annual return of 12.57%, according to data compiled by TradeThatSwing.com. This is the powerful engine of compound growth you need to harness. Let's stop talking and do the math. Take that $4,000 you lost. If you had invested it and let it compound at that average rate of 12.57% for 30 years, do you know what it would have grown to? $135,842. That is the real cost of a bad gamble. It is not a $4,000 mistake. It is a six-figure mistake. You didn't just lose a portion of your savings. You lost a significant piece of your future financial independence. You lost the down payment on a house, your kids' college education, or years of your retirement. When you frame it this way, the choice becomes incredibly clear. The risk of a speculative bet isn't just losing your initial stake. It's sacrificing a future of wealth for a moment of excitement. Let's check back in with Alex. After seeing that 65% underperformance statistic from S&P, it was like a light bulb went off. The immense pressure to be a stock-picking genius, to find that one magic stock, just vanished. The realization that even the pros fail at that game was incredibly freeing, but it was replaced by a new, more logical fear. Alex was now caught between two definite risks: the guaranteed loss from inflation by doing nothing, and the potential for a massive future loss from a speculative mistake. The question was no longer, how do I get rich? It was, which path minimizes my risk while still allowing my money to grow? The data provided the answer. Alex accepted that the goal was not to beat the market, but to simply be the market by using a tool like an index fund. Then, Alex did the personal math. Losing $300 a year to inflation was completely unacceptable, but it was the $135,000 mistake calculation that truly solidified the decision. That number was visceral. It made the idea of gambling with this hard-earned money feel totally irresponsible. With this new clarity, Alex was fully convinced and motivated. The fear of missing out on a hot stock was replaced by the fear of inaction. The goal had shifted permanently from get rich quick to build wealth safely and reliably. If that 65% number surprised you, comment surprised below. Now that you know why to avoid gambling, let's build your exact 15-minute plan. Okay, 3 simple steps. This entire process takes less time than ordering a pizza. Don't blink. The goal here is to move from a state of anxiety and indecision to having a fully automated investment system in the next 15 minutes. Step 1. Choose a home for your money. This is the brokerage account. People get stuck here for weeks in analysis paralysis, comparing dozens of options. Don't. The most important thing is to start. Open an account with one of the major low-cost brokerages. According to NerdWallet's 2024 review of the best brokers, top choices for beginners are Fidelity, Vanguard, or Charles Schwab. These aren't random companies. They are industry titans. They are reputable. And most importantly for a beginner, they have $0 minimums to open an account. This means you can get started with any amount of money. The differences between them for a new investor are negligible. Pick one, go to their website or download their app, and open a standard brokerage account. It's like opening a bank account. You'll need your social security number and some basic personal information. This step should take you about 5 to 7 minutes. Do not overthink it. Just pick one and execute. Step 2. Pick the investment. Now that you have a home for your money, you need to decide what to buy. And based on everything we've just discussed, you are not buying individual stocks. You are not trying to pick the next Tesla or Amazon. You are buying the whole market. You do this through a low-cost, broad market index fund. An index fund is a single investment that holds stocks in hundreds or even thousands of companies. It's the definition of diversification. By buying one share of an index fund, you own a tiny piece of the entire U.S. economy. Again, don't get lost in the options. Two of the most popular and best examples are Fidelity's 500 Index Fund, ticker symbol FXAIX, or Vanguard's Total Stock Market Index Fund, VTSAX. The key here is low cost. We measure cost by something called an expense ratio, which is the tiny annual fee the fund company charges to manage everything. The expense ratio for FXAIX is just 0.015%. For VTSAX, it's 0.04%. These fees are so low they're almost unbelievable. Let's put that in perspective. A 0.015% fee on your $10,000 is just $1.50 per year. That's it. For less than the price of a cup of coffee, you get to own a piece of the 500 largest companies in America. This is why index funds are so powerful. Nearly 100% of your money is working for you, not going into the pockets of some fund manager who, as we've established, probably won't beat the market anyway. Step 3. Automate everything. This is, without a doubt, the most crucial step of the entire process. This is the step that protects you from your own psychology. Your biggest enemy in investing is not the market. It's the emotional, impulsive person you see in the mirror. The best way to defeat that enemy is to take them out of the equation. Once your brokerage account is open and linked to your bank account, you need to set up an automatic transfer and an automatic investment for every single payday. Whether it's $50, $100, or $500 per paycheck, schedule it to be automatically pulled from your bank and automatically invested into the index fund you chose. Do not do it manually. By automating it, you commit to investing whether the market is up or down. You remove the temptation to time the market, which is a fool's errand. You take the emotion, the fear, the greed, the hesitation completely out of the process. This is how you build real, sustainable wealth. It's not about brilliant moves. It's about relentless consistency. This is the system that runs on autopilot, building your wealth in the background while you live your life. It is the single most powerful tool at your disposal. Let's finish Alex's story. Armed with the data and a clear why, Alex was finally ready for the how. The anxiety about the complexity of investing was gone, replaced by a clear action plan. The belief that this process required expensive advisors and mountains of paperwork was shattered. So Alex pulled out a phone right then and there. Step 1. Download the Fidelity app. 5 minutes later, after filling in the basics, the account was open. Step 2. Link the bank account and initiate a transfer for the $10,000. Once the funds settled, Alex bought shares of FXAIX. Step 3. The final, most important piece. Alex set up a recurring investment. Every 2 weeks, on payday, $200 would automatically transfer from checking and buy more shares of FXAIX. The entire process from downloading the app to having a fully automated investment system in place took less than 15 minutes. The feeling that washed over Alex wasn't excitement. It was a profound sense of relief. It was the feeling of control, of empowerment. That $10,000 was no longer dangerous money sitting idle and causing stress. It was now working money, quietly and systematically building a foundation for the future. Alex went from being paralyzed with fear to being an investor with a plan, all in the time it takes to get a haircut. Let's bring it all together. The journey from saver to investor is mostly a mental one. Your first $10,000 feels dangerous because it's a huge achievement, statistically placing you with nearly double the median savings for your peers. But this psychological pressure can lead you straight into the trap of making emotional, speculative decisions. The data is undeniable. Trying to outsmart the market is a losing game, with 65% of professionals failing to do so, according to S&P's 2024 research. The real tangible risks you face are not picking the wrong stock, but the silent erosion of 3.0% inflation and the massive six-figure opportunity cost of a major mistake. Finally, the solution is not complex. It's a simple 15-minute 3-step plan. Opening an account at a major brokerage like Fidelity, buying a low-cost index fund like FXAIX, and, most importantly, automating your contributions is your most powerful and reliable path to building long-term wealth. So here are your action steps. First, the immediate step. Right now, before you close this browser tab or switch apps on your phone, choose one of the brokerages I mentioned, Fidelity, Vanguard, or Schwab, and open the account. It takes 5 minutes. Just get it done. Next, your short-term goal. This week, initiate the transfer of your funds from your bank to your new brokerage account. Once the money arrives, make your first index fund purchase. You will officially be an investor. And your long-term commitment. Set up your automatic investment plan. Decide on an amount you can